want to look at account receivable now. For account receivables, also you always think about what is account receivable all about. Account receivable will come because we have sold something. So usually it starts from your opening balance plus sales, which are credit sales, because we have account receivable because we have sold goods and we have not collected money. So plus sales, which will be our additions, minus payment received, because when customer paid us, yeah, it will reduce our receivable. Then some bad allowances, bad debt. So we need to make those bad debt allowance. Which standard requires us to do IFRS 9. By the time we've done all of that, whatever we have left will be our closing account receivable. So it's always very important to understand how those balances are being come about. When you understand them, then you understand why such procedures are necessary. Yeah, because I can imagine someone asking you to come up with procedures for account receivable. Probably the only thing you'll be thinking about is confirmation and your stock. There are a lot of procedures you can come about because everything you say about each of these items is a very good procedure, except the question is specific and says, how do you test payment receipt? Or how do you test bad debt allowance? Or how do you test sales? Then you need to be specific for that particular item. But if it's about the closing balance, all of this, any procedure you put forward in any of these is excellent, right? And any opening balance in this world, any opening balance, and I say again, any opening balance, the only way you test it is by comparing the figure to the prior year audited financial statement. So that is an easy procedure and it's done and dusted like that, right? So, but remember, our approach is need to identify the assertions that are necessary for this balance. So for account receivables, it's an asset, which means it's an item on statement of financial position. And what does that mean? It means that we'll be focusing on this part of assertions, right? And I'll just list them out here again for you. So we're talking about existence, we're talking about rights, we're talking about accuracy and valuation, very critical. We're talking of completeness, talking of presentation and disclosure. Yeah. So we're talking of all of that. These are assertions that are very, very important. And in last class, someone was asking about risk and procedure. And I remember I explained to you, remember, what you are trying to address when you are doing these procedures is the risk. You want to take away audit risk because your audit risk is the possibility of you coming into a wrong conclusion when you are doing the audit, issuing a wrong opinion, saying that account receivable is not misstated, whereas it is misstated. So you don't want that risk to crystallize. And that is why you have to design a proper and appropriate procedure such that you are able to get a result that is correct. It doesn't have to be good, it can be bad. But when it is bad, you need to see that it's bad. And when it is good, you have to be confident that it is really good. Right. So these are the assertions that will confirm to you that account receivable is not misstated. So you need confidence or comfort on each of them for you to be able to um, have that confidence. And questions can be tricky. They might not even talk about the balance as a whole. They might actually pick one assertion here and say, how do you get confidence or how do you come up with procedures on how you would test the existence of account receivable or how you would test valuation assertions of account receivable? So you need to know how each assertion address a balance. What is the meaning of assertion? We've gone through all of that. Yeah. So that you're not giving a wrong procedure for a wrong assertion. Yeah. So that is quite important. And you need to know what those procedures are we going to use. So for existence, what procedures do we need to use for existence? It's a very popular procedure that you know, and that is your confirmation letter. And I'll spend a little time on this confirmation letter. Let me quickly do that here. So, confirmation letter, what is confirmation letter? Confirmation letter is that letter you send to your client. So, the client will send it to their customers. Yeah. So, confirmation letters. So, usually clients will send this to their customers. And what are they saying? They are asking the customers to confirm the balance that they are owing them. So that,
Client
okay.
will send. Hi, Di. I have a question here.
Yeah.
The client would send it to customer, but while we are performing the procedures, wouldn't the auditor send it to the customers?
So the way it works is this: the letter must be on the letterhead of the client. So usually it's not the auditor. That auditor will post it, right? However, it doesn't. The letter will not address the customer as if it's coming from the auditors. Get it right. This is the way the letter will be stated. Something like this. Let's say if your client is company J and your customer is AB. The address on that letter will just be like this. Assuming this is a letter, this will be company J. Yeah. And they are writing to AB. And they are saying, hello, madam. Our auditor would like to know the balance that you are owing us. That's one way of writing it. Kindly write to us back confirming how much you are owing. That's one way. They can also write and say, in our books, you are owing us $50. Please, can you confirm that you are owing us this amount? And if not, let us know how much you think you are owing us, if there's any discrepancy. And the client will sign. That letter will be given to the auditors. The auditors will post it. And when those responses come back, the auditors will get them back as well. So everything is being, the administrative part is the only part the auditors will do. But in terms of the letter itself, the letter is written from the client to the customer. Not so a KPMG will not prepare a letter to a customer. No, the client will prepare the letter to their customer. Only left for the auditors to just post it and receive responses. I hope it's clear.
Yes, it's pretty clear now.
Yeah, yeah,
Thank you.
yeah. So, and this is really very important, especially in the audit of account receivable, confirmation letter. You cannot finish that audit without confirmation letters because this confirmation letter addresses a lot of assertions. It addresses existence, it addresses right, it addresses even valuation. You can see one procedure, and you can see how you can be efficient with audit when you are especially in practice, in the real practice sense, when we don't have so much time to spend. When you can find such a procedure that can tick a lot of assertions for you, those are your best procedures, right? And that's why if you're auditing account receivable and you're not talking of confirmation letters, it's almost impossible to be speaking properly because this procedure one alone can touch on existence. Because if a client can respond back and say, yes, we are owing you $20 million, we agree, that means it existed. That means your client has the right to collect the money because the person owing has already confirmed. That means the amount is correct. Valuation and accuracy, because the man has also confirmed the amount. And that's the third party evidence, which we all agreed from 2 lectures ago or last lecture, so 2 lectures ago, when we looked at those procedures, that a third party evidence is even better than the client evidence. And the customer replying back is a third party evidence, right? So that's a very important procedure, and by no way most important than any procedure you can have for AR testing. Right. But I want to tell you there are two types of confirmation letter. So there are two types. we have a positive confirmation, and we have a negative confirmation, and they are different. So, positive confirmation is what I explained earlier, which is either the client is asking the customer to confirm the amount they have stated on the letter, or they can leave the letter without any amount and asking their customer to just tell them how much they believe they are owing. So I can say, AB, confirm you are owing us $30 million. That is one way of saying it. It's positive confirmation. Confirm you are owing 30 million. And if you are not owing 30 million, please let me know how much you are owing. They can as well say, AB, please tell us how much you are owing without necessarily putting any amount. This is positive confirmation, because in positive confirmation, clients must respond. That is why it's positive. Must respond. However, negative confirmation is different. In negative confirmation, this is the way the confirmation letter is written. I will tell the clients, listen, and say, AB, by our books and records, you are owing $20 million, and our auditors would like to know whether this figure is correct. Please, if you do not agree with this number, kindly respond to us on the amount you believe you are owing. You see the difference. The difference is that in negative confirmation, customers will only reply when they disagree. So here, unlike when customer, not client, it's customer that I'm referring to here, please. It's customers that must reply to confirmation. I mean customers, right? So, but in negative, customers only replies when there is disagreement. If there's no disagreement, they will not reply, which means that if they don't reply, everything is fine. That's the assumption. That means everything is fine. But if they reply, then things are not fine. So, but in the place of audit, which one do you think would be better to give better evidence, positive or negative?
Positive.
Exactly, positive. So in audit, you are advised to do a positive confirmation. And the reason being that if you do a negative confirmation, which means you only expect client to respond when there's a discrepancy, a client might not even get the letter. A client might even forget to respond to the letter. And once they don't respond, auditors will just assume as if everything is fine, whereas everything might not be fine. So that is why positive confirmation is actually the better way of performing your external confirmation. And please take note of that. Yeah. And that is confirmation, which, like I said, will address your existence, will address your rights, will address your accuracy and valuation. Yeah. And presentation and disclosure is about reviewing financial statements to be sure that the disclosures have been done properly. Account receivable has been put in current assets and not in non-current asset, and even not in P&L. You understand? So it's been properly presented, and all disclosures written to the allowances have also been made. Now, on completeness, how do you know that everything has been recorded the way they should be recorded? This is where you need to look at this table, which is your movement schedule of account receivable. By the time you've tested all of this, you can be rest assured that you have completeness, which means we need to look at each of these. Yeah. So opening balance, I've told you the only way to audit it is to check it with the prior year audited financial statement. But you need to audit sales. You need to audit sales. And the major thing you will do on sales, so let's take sales. So we can't finish account receivable without looking at sales. And sales, remember, it's a P&L item. So which means cutoff is big D and occurrence will be a big D. These two items will be the major focus for us. So you need to know how to test for cutoff of sales and occurrence of sales. The easier one is the occurrence of sales, which is where you just need to trace the sale figures to the sale invoice. Easy. This one, I want to take it separately because it's a bit complex. Not that complex, but just I need you to pay attention. Yeah, remember I explained cutoff as an assertion. Cutoff is about you ensuring that the transactions before the year end has been recorded and the transactions after the year end has been excluded. So if this 31st of December 2024, only transactions here should be in the financial statement, and any transactions on the other side should be excluded. This should not be in our financials because this is 2025 and we are only focusing on 2024. So because we have chosen December 31st as our cutoff date, that's why the assertion is called cutoff. This is our cutoff date, which is our reporting date. Transactions before stays in the financial statement. Transactions after should not be in our financial statement. So, which means, how do we know that sales are occurred before the cutoff date? The focus is on a document called the delivery note. Because sales is only recognized when the obligations have been settled. If you remember your IFRS 15. Right. So delivery note is what you get when you have received, when you have delivered an item. So when I'm selling an item, immediately I deliver to you, I have made sales. Whether you have paid or not is not a problem because our payment terms can be 30 days, can be 45 days, so it doesn't matter. The main thing is, do I have a delivery note showing that I've delivered the items? Which means to test for cutoff, you need to check that delivery notes before the year end have been recorded in sales. And delivery notes after the year end have been excluded from the sales. So you can see it's not just one way. I didn't stop here. No, you have to add this other part to it because it's a two-way testing. You're testing this side and you're also testing this side. So if the question is asking you a cutoff procedures and you just put one side, that is not correct. You will not even score any mark for it, unfortunately. You have to
Um,
go ahead.
so when you say the delivery notes that before the year end you're talking about is or cutoff date, right?
Yes, yeah.
Okay.
So when you select samples of delivery notes, you check the date on those delivery notes. Is it 29th of December? If it is 29th of December, yeah, then you need to go and check that that has been included in the sales ledger for that financial statement. And if the date on the delivery note is 2nd of January 2025, then you need to check that it has not been included in your financial statement because that has passed your cutoff date. Because that means that delivery was done after the year end, and in that case, the revenue would not be meant for the 2024 and now is for 2025 because the delivery happened after the cutoff date, right? So that is cutoff testing for uh for revenue. Yeah, very important, and you need to know how to do it because it affects your account receivable. Yeah, so that will address your addition here, this part, those procedures.
I
Now,
have a
payment.
question, please.
Please go ahead.
You are saying that we will test the delivery notes for cutoff date. Can we test the sales invoices for cutoff date? For cutoff?
For cutoff, you cannot use invoices because invoices does not signify the point of sale. Remember, what you must first of all ask yourself is when is sales meant to occur? No occurrence. When will you say sale has occurred? That's the first question you ask yourself. Is it when invoice has been issued or when delivery note has been issued? What comes first? Because if you deliver 31st of December, you might issue invoice 2nd of January, and that sales will be for the last year. But if you are using your invoice, you will be saying the sale is for the next year. Delivery
I,
note, yeah. Delivery note is the point when sales has occurred. Is at the point when delivery has been made. And it's possible that invoice was not issued immediately. In fact, most times, invoice is issued after delivery note because it's possible that you deliver and the client rejects that delivery and you cannot invoice the client. So mostly invoice is triggered when the client has accepted delivery and there's an evidence that we have sold. Then now we can collect money. And that is why when the delivery notes exist, you booked entry, which is account receivable is debited and sales is credited. And when you issue invoice and invoice is paid, you credit account receivable and you debit your bank because you have received money. But this is when sales occurred, not here. Make sense?
it does. Thank you.
Yeah, nice. So very important to understand that part. The second part is the payment receipt. You need to also know how to test that, and that is pretty straightforward. The only way to test any payment is to trace to bank statement. It's as simple as that. If the customers has paid, then the money should be in the bank and we should be able to trace it to the bank statement. So you select samples of payment and check the bank statement of your client to be sure that they actually receive the inflow from the client. So no sweating on that. The last part is the bad debt allowance, which you also need to
Sorry,
know.
Dial. Can you just go through that one again? Select samples of payments, did you say?
Yes, yes.
And what do you cast that to?
So you need to trace that to the bank statement of your clients. So take for
Um,
instance, if you are KPMG and you are auditing Apple, and Apple has sold some phones to their customers, right? Then if Apple is coming
sorry.
to tell you, can I go ahead or you want?
Yeah, sorry.
Okay. So you are auditing Apple and you are auditing Apple account receivable. Apple
Yeah.
has sold some phones to some companies, to some customers, and you want to check whether the receivable balance is correct. Now, in that receivable movement schedule, there's a portion that is called payment that has been received. So you now need to select some of those payments that they claim have been received. And you now say, Apple, can I have your bank statement? Because you said this payment have been received. I need to trace this statement, this payment that you said you have received to the bank statement. So Apple will now give you their bank statement. You will now check and see where those monies actually came in. So you are checking the inflows. Oh, Mr. A paid $25 million. Okay, I can see it. It came into your HSBC bank account on 21st of December 2024. So with that, you will say truly payment has received because you need to be sure that they are valid. Like we said, you must exhibit professional skepticism, which means nothing is true until you have an evidence. Yeah. So I hope that is clear.
Yeah. Thank you.
Awesome. Yeah. Okay, so that's payment, very straightforward. Payment or whether receipt of money or payment, whatever it is you are tracing to the bank statement, that's all you have to do. That's the best audit procedure for that. The last part is the bad debt allowance, which is very critical as well. Yeah, bad debt allowance. In fact, you can have a question just on bad debt allowance. Yeah, it's very important you understand this one. Yeah, and this is tricky because it's an estimate. And I told you, any estimate you get is just similar to depreciation. Remember, depreciation is also an estimate. And in that case, what does it mean? Two things must be tested. You must test the policy and you must test the amount. Policy and the amount. Those are the two things you must focus on anytime we are talking about any estimate. Because estimate is always the client estimate, your client estimate, and they will have a policy around it. So you need to know that what they are doing is actually appropriate and they have also done it appropriately. That's the amount. So how do we test that the policy is correct? It's just testing for reasonableness. So test for reasonableness of policy. You will see some.
Something like this, would this be something that you can review from maybe meetings from like minutes from the meetings with directors to see if there's any discussion on that or no?
Okay. So, that's why I like you speaking because the more you speak, the more value you get from me. Right. Honestly. Right. So, that procedure you mentioned is a very overused procedure, but most time it's not relevant to a lot of things. Yeah.
Okay.
Anytime you want to test a policy, any policy, whether it's depreciation, whether it's on allowance, the way to test it is to compare it to a benchmark. So always compare to the industry. That is the only
Mm.
way. You are always comparing to the industry. What are the other people in the industry doing? Are they doing similar thing? With that, you will know that it is reasonable. That's the same way we tested for depreciation policy. And it is applicable to any policy you want to test. You must check what is the industry standard compared to the industry. That is the way to do it. Yeah. If it is similar to what other people in the industry are doing, yeah, that means reasonable. But if not, then it's unreasonable. Then once you test that the policy is reasonable, you've compared to the industry, then you need to test the amount. And that means you need to do recalculation based on the policy. Recalculate. Let me write it. I think that space is too small. So you need to do recalculation. So you recalculate based on the policy. Some policy might say, for receivables that are older than 30 days, we don't do any allowance, zero. If it is more than 60 days, we'll make 10% allowance. If it's more than 120 days, I'm just giving an example of a policy that I've seen before on allowance provision. You may say they will do 50% provision. For anything that is more than 360 days, they will say they will make 100% provision, which means that they are saying that if a customer has not paid them for 1 year, they will believe that the whole amount will not be paid and they will make provision for the whole amount. If it's just 120 days, they make 50% provision. If it's just 60 days, they make 10%. If it's just 30 days, they believe that it is just an error. The customer just forgot and will still pay back. So they don't make any provision. So this is an example of a policy that they can give you for allowance. And if you want to test it, you check the industry and see whether this policy is similar to what the industry is doing. If it's good with the industry, then you need to do recalculation. And that's when you now do your own calculation of provisioning based on the aging of receivables and based on this policy. And that is recalculation because then you'll be testing for the accuracy of that figure. Okay? You are reconciling the policy with the actual. The policy has said this, but have they computed the same amount based on the policy? Are they aligned? That is what you are doing. So remember, any policy is about the policy testing, which is about reasonableness. And after that, you check for the accuracy of the amount. That is how you check for any estimate. It is as simple as that. And that is everything you need to understand on account receivable. And you see, we've not really, I know I've spoken about all the procedures sort of, but I'm not interested in going to solving questions because you have to understand this first. If you don't understand all of this, it will be a struggle. Yeah, and you can see where we're coming from. We said for we've done R&D. We said these three conditions must be met before it can exist. So which means your procedures must be testing each of them. Yeah, and likewise you check for the accuracy, you check for the right and amortizations and all of that. Account receivable is another one we looked at today. We said this is how we come about the account receivable balance. Yeah, it's about opening plus sales plus minus payment minus allowance, and each of these items must be tested. Yeah, and we said the best procedure is the confirmation letters, which can be negative and can be also positive. Positive is the best one. To test for rights, yeah, invoices will give you right, though your confirmation will also give you, but invoices will help you with that. Likewise, even valuation invoices will help you. Right. But we'll go into detail of procedures when we are doing those exam questions. But I believe this introduction will really help you understand the process such that when we are designing procedures, it will be making sense and you will never have to memorize once you understand. Okay, I think that's a good way to end it for account receivable.